Yes, people, done with your break? Welcome back after break. So, guys, before break, we were discussing about the amalgamation and demerger. We have completed amalgamation and demerger. Hope so you understood this question. Question number 1. Is there any doubt? Any doubt in question number 1? Then just tell me. Any doubt? Okay, there is one question from Varsha. Sir, if resulting company holds 75% share of demerged company, then condition D of demerger can't be satisfied, right? But Varsha, in this particular case, what will happen? Yeah, that is not satisfied, right? Geo Financial Limited came into existence after demerger, then how can it be a shareholder in Geo? But there may be possibility that from earlier, Geo Financial was incorporated 1 or 2 years ago also. That is, there may be possibility. There may be possibility. Okay, done. Now, guys, question number 1. You have done the question number 1. Any doubt in question number 1? So question number 1 is very interesting question. In 2015 November, this question I asked for the 10 marks question. Okay. Now, guys, in our capital gain, some part was pending related to the amalgamation and demerger. If you remember, amalgamation and demerger, some part in the capital gain topic, page number in section 47. In section 47 here in section 47 on the page number 42. Just check the page number 42. Now just check the page number 42. So guys, here we have mentioned that we'll discuss with amalgamation and demerger topic. So first part is an amalgamation. Now what this first point says that transfer of any capital asset by amalgamating company to amalgamated company. So whenever amalgamating company transfer asset to the amalgamated company, our example was like that Vodafone to Vodafone Idea or Idea to Vodafone Idea. Then in case of the in hands of the amalgamating company, there is no transfer, capital gain is not applicable. But there is a condition that amalgamated company should be the Indian company, that new company should be the Indian company. So section 47 is about the following transaction not regarded as transfer, capital gain is not applicable. So whenever amalgamating company transfer capital asset to amalgamated company and amalgamated company is an Indian company, then it is not treated as transfer, capital gain is not applicable. Now guys, just check the last point. Last point is a surrender of share in the amalgamating company by shareholder of amalgamating company to amalgamated company. So guys, shareholder of amalgamating company is going to receive the share of amalgamated company in exchange of share of amalgamating company. So that time it is not treated as transfer, capital gain is not applicable. But in future, if he transfer the amalgamated company share, then what is the cost of acquisition? Cost of acquisition of previous company share, period of holding is also from the previous company, and if there is an indexation, then also from the previous company. But guys, there are some condition. Condition is first condition, consideration. What he received the consideration? Shareholder received the consideration of new company share. Only allotment of the share in the amalgamated company. But there is one exception, except when amalgamated company itself is a shareholder. So when amalgamated company itself is a shareholder, then amalgamated company cannot issue the share like their own share to amalgamated company. So obviously it's not possible. So here consideration is only shares of the new company, and amalgamated company is an Indian company. Now guys, there is one more point. That point says that transfer of shares in Indian company or shares of foreign company which derive its value from the shares of Indian company referred to in explanation 5 to section 911 by amalgamating foreign company to the amalgamated foreign company. Now what is this? I am going to take one example, and from that example we will understand. All people pay attention. Suppose here we can take one example. Try to understand. Guys, in foreign, there is one company, name is a Sunny Limited. Now the Sunny Limited is foreign company, and Sunny Limited is located in the USA. Sunny Limited is foreign company located in USA. Now guys, this Sunny Limited is foreign company located in the USA. There is one more company, name is a Kim Limited. This Kim Limited is also foreign company. and that Kim Limited is located in UK. Kim Limited located in the UK. That is also foreign company. Now guys, is this Sunny Limited, this first foreign company, is having the shares of any Indian company. Example is, suppose they are having the shares of Reliance Industries Limited. Reliance Industries Limited, a Indian company. Now guys, there is a amalgamation of Sunny Limited and Kim Limited. Means there is a amalgamation of two foreign company. So amalgamation of two foreign company means here Sunny Limited is merged with the Kim Limited. Sunny Limited is going to be merged with the Kim Limited. Sunny Limited is going to be merged with the Kim Limited. So there is an amalgamation, and Sunny Limited is known as the amalgamating company and Kim Limited is a amalgamated company. So guys, in amalgamation, what will happen? This Indian company share will got also transferred to the new company. This Indian company share, that Reliance, because Sunny was holding the share of Reliance Industries Limited, this Reliance Industries Limited share also transferred to the Kim Limited. Reliance Industries share transferred to the Kim Limited under the amalgamation. Lawmaker says that in this case also, in hands of Sunny Limited, there is no transfer, capital gain is not applicable. There is no transfer, capital gain is not applicable. Capital gain is not applicable. It means when Indian company share is transferred by one foreign company to the another foreign company under the amalgamation, then in hands of this foreign company, capital gain is not applicable. It is not treated as transfer, but there are certain conditions. What are conditions? We'll discuss later. Now one more point. This point says one more point. Yes, suppose for an example, Sunny Limited is holding the share of one company. Name is a John Limited, and this John Limited is basically located in the USA. Suppose John Limited is located in USA. So there are three foreign company. Sunny Limited is foreign company. Here this Kim Limited is foreign company, and John Limited is also foreign company. But guys, this John Limited derive its value from Indian asset. John Limited, suppose John Limited is a holding company of one Indian company name is a Reliance Industries Limited. You know that on the first day when we were discussing one case law of the Vodafone, and in Vodafone case law, what happened? In Vodafone case law, if you remember, then in Vodafone case law, what happened? Like three foreign company was there. And one foreign company transferred the share of the another foreign company to the third foreign company. And I have mentioned that Supreme Court gave the judgment in the favor of Vodafone. But after that, lawmakers made the amendment, and lawmakers mentioned that suppose if any foreign company derive its value from Indian asset. So for an example, this foreign company is a John Limited. Now this John Limited, suppose this John Limited derive its value from Indian asset. For an example, this John Limited is derive its value from Indian asset, then share of John Limited is deemed to be located in India. And if you transfer the John Limited share now, then also capital gain is applicable in India. Now what happened? Here lawmakers made one exception. Suppose Sunny Limited is amalgamating with the Kim Limited. If Sunny Limited is going to be merged with the Kim Limited and Sunny Limited transfer the share of the John Limited, even that John Limited share value is derived from Indian asset, it is treated as Indian asset, then also capital gain is not applicable. It is not treated as transfer. So in this point, there are basically 2 points. One is either Sunny Limited transfer share of any Indian company, or Sunny Limited transfer share of any foreign company, and that foreign company derive its value from the Indian asset to another foreign company under the amalgamation, then it is not treated as transfer. Capital gain is not applicable. Now what are the conditions here? So all people pay attention here. Again, we are reading point number 2. So either transfer of share in Indian company. Transfer of share in Indian company means Indian company share is transfer, or shares of foreign company which derive its value from the shares of Indian company. Now sir, when foreign company which will derive their value from Indian asset, that we will discuss in the international taxation. That is the explanation 5 of section 911 by amalgamating foreign company to the amalgamated foreign company. But condition is At least 25% of shareholder of amalgamating foreign company continue to be the shareholder of amalgamated foreign company. Sir, here condition is 25% only. Answer is yes. Here it is a 25%. Means Sunny Limited shareholder, that 25% shareholder of Sunny Limited are going to be shareholder of the Kim Limited, 25%. And second condition, such transfer does not attract the tax in the country in which amalgamating company is incorporated. Amalgamating company is incorporated means amalgamating company means Sunny Limited. Sunny Limited is incorporated in the USA. So in the USA also, this transfer is a tax free. Then in India, we are not going to charge any tax. This is all about the amalgamation. Now guys, there is one more point. Okay, transfer of capital asset under the scheme of amalgamation of banking company with the banking institution. Now, if you remember, then I think 25 years ago, that all bank they did the nationalize, like Indira Gandhi. At the time of Indira Gandhi, like earlier that bank was private, but all bank acquired by Indira Gandhi, and Indira Gandhi mentioned that now every bank is a nationalized bank. So what happened? That banking company was a private bank. Suppose they merge with the government bank, like in SBI, State Bank of India. There were various SBI, State Bank of Bikaner, Jaipur and all. So earlier there were private bank and they merged with that bank. So that is also not treated as transfer. Capital gain is not applicable. So as per section 45(7) Banking Regulation Act 1949, as per that act, if there is a merger, then it is not treated as transfer. Capital gain is not applicable. There is no, this point is not relevant for the examination point of view. Now guys, demerger. Now demerger says that get transfer of any capital asset by demerged company to the resulting company. Demerged company to the resulting company, example is the Reliance. So in case of the Reliance, if any capital asset is transferred to the Geo Financial Service, then it is not treated as transfer. Capital gain is not applicable, but condition is that resulting company is a Indian company. Now one more point. Transfer of shares in the Indian company or shares of foreign company which derive its value from the Indian company by demerged foreign company to the resulting foreign company. But condition is if shareholder holding at least 75%, here it is a 75%, value of share in the demerged company continue to be shareholder of resulting company, and such transfer does not attract tax in the country in which the demerged company is incorporated. Now what is the meaning of that? Here I can take one example. Suppose guys, Sunny Limited. Sunny Limited is one foreign company. Now Sunny Limited is one foreign company and Sunny Limited is having suppose two segment. Sunny Limited, one foreign company, is having two segments, that is A and B. And suppose B segment is demerged and they made one new company, that is the B Limited. So guys, this Sunny Limited is holding the shares of any Indian company or they are holding the shares of any foreign company which derive its value from the Indian asset. So here guys, when Sunny Limited transfer the shares of any Indian company or foreign company who derive its value from the Indian asset to the B Limited under demerger, then it is not treated as transfer. Capital gain is not applicable. There are two conditions, that Sunny Limited at least 75% shareholder will become the shareholder of the B Limited, and guys here there is no tax in the USA. So whenever if this foreign company Sunny Limited went for the demerger, then in USA there is no tax on the demerger. If both the conditions are satisfied, then Indian company share were transfer under demerger by foreign company to the another foreign company, or any foreign company share transfer by this foreign company to another foreign company, and this foreign company share derive its value from the Indian asset, then it is not treated as transfer. Capital gain is not applicable. So here last point, issue of share by resulting company to shareholder of demerged company. Guys, I was holding the share of the Reliance. Now I got the shares of the Geo. So Geo issue the share to the shareholder of demerged company. Is it treated as transfer? Is capital gain is applicable? Answer is no. So when you receive the share of the new company, because you were holding the share of Reliance, so now you got the share of the Geo. So that is not treated as transfer. Capital gain is not applicable. So here, shareholder receive the share of resulting company is not treated as transfer of the share of demerged company. You got my point or not? Yes. So this is the completion of your amalgamation and demerger. So we have completed till amalgamation and demerger. This Saturday there will be a one test, and in that test paper I will not ask you capital gain, other sources and basic concepts. So in simple word, I am going to ask you the dividend related taxation, buyback, as well as liquidation and bonus stripping. So this topic I will ask you in this Saturday test. Okay. Now guys, we are going to discuss the last test paper. So directly check your last test paper. So last test paper, we are going to discuss test paper number 2. Let's see. how you perform in that test paper. Test paper number 2. Yes, people. So we are going to check the test paper number 2. Test paper number 2. All people ready for test paper? Okay. So first multiple choice question. All people pay attention. In previous year 23-24, Mr. A has transferred the following asset. So Mr. A has transferred this asset. One, he transferred the residential house property for the 8 crore rupees and index cost of acquisition was 6 crore. And date of transfer in current year on the 25th November 2023. So can I say that here it is a long-term capital gain because index cost of acquisition is given. It means long-term capital gain of the 2 crore here. Here long-term capital gain is 2 crore on the residential house property. Jewelry also transfer for the 3 crore and cost of acquisition index cost is given 2 crore and it is transfer on 5th January 2024. Now guys, Mr. A bought a new residential house property on 1/4/2022. Guys, this property is transferred on the 25th November 2023 and he purchased, is he purchased in -1? Answer is no. He has not purchased in the -1 because -1 is treated as 26/11/2022 and he purchased on 1/4/2022. So for this particular 1 crore, obviously that 54 exemption is not available because this property is not purchased within -1 because new property should be purchased within 1 year before the date of transfer, but it has not purchased within 1 year before the date of transfer. So exemption on this property is not available. Now guys, what happened? On 28 Feb 2024, in the current year only, he deposited 3 crore in the capital gain deposit account scheme. So he deposited in the CGS account of 3 crore. And on 30th July 2024, Mr. A has withdrawn total 3 crore. Before the due date of return filing only, he withdrew the total 3 crore from capital gain deposit account and acquired a residential house property worth 2.5 crore. He purchased the residential house property worth 2.5 crore. What would be the capital gain in hands of Mr. A for the assessment year 24-25 if the expenses in connection with the transfer of jewelry were the 2 lakh rupees? Now you have to calculate the capital gain here. So guys, can I say that? Try to understand here. First, we will calculate the capital gain on residential property. So here, one is the residential house property and guys, one is the residential house property and one is your jewelry. One is your jewelry. Now residential house property, your full value of consideration is 8 crore. 8 crore minus index cost of acquisition is 6 crore. So 2 crore is your gross LTCG. Gross LTCG is 2 crore. Now, in case of the jewelry, can I say that your full value of consideration is 3 crore minus transfer expenses? There was 2 lakh rupees transfer expenses. So, can I say that here 2 lakh means 0.02 crore? 0.02 crore. And guys, your index cost of acquisition is for the jewelry, it is a 2 crore. So, can I say that here your 3 crore minus 0.02 crore minus 2 crore. So it comes to the 98 lakhs. Here I am writing 98 lakhs. 98 lakhs. 98 lakhs. 98 lakh is a gross LTCG. Now guys, you purchase the residential house property. You purchase the residential house property. So against this residential house property, Shiva, can I say that you can claim the exemption under section 54? So here your exemption under section 54 is available for 2 crore because you purchase the residential house property for 2.5 crore. You purchase the residential house property for 2.5 crore. So against this 2 crore, you can claim the 54 exemption. So this is totally exempted. Now 50 lakh more you invested in the house property. Now question is that you are holding one property already because one property you purchased in 2022, that you hold the one property. Now you purchase one more property. Can you claim the 54F exemption or not? Answer is yes. Again, jewelry, you can purchase the 54F exemption. Here you purchase this one property. Now 2 crore is exempted here. Now 50 lakh is also one cost. 50 lakh is excess cost. 50 lakh exemption still you have not claimed. So 50 lakh exemption you can claim against the jewelry. But if you remember the section 54F, you transfer any long-term capital asset and just acquire the residential house property. 54F exemption is available. But in that section there was a point if your net consideration is fully utilized or not. Because if you check the jewelry then your jewelry net consideration is your 2.98 crore. Right, your net consideration is 2.98 crore because 2 lakh is transfer expenses, so net consideration is 2.98 crore. Here you are investing only 50 lakh rupees because 2 crore already you claim the exemption under section 54, so you are investing only 50 lakh. So can I say that your 2.98 crore, that 2.98 crore net consideration is not utilized? So here exemption is available on the formula basis. Here exemption is available on the formula basis. It means your 98 lakh exemption can be claimed if you invest the 298 lakhs, means 2 crore 98 lakh net consideration, multiply by how much you invested, only 50 lakh. Here you invested only 50 lakh, so 98 lakh divided by 298 multiply by 50, so it comes to the, I think it comes to the 16 lakh something. It comes to the 16 lakh 44,295. So what is the remaining capital gain? 98 lakh minus 16 lakh 44,295. So remaining is 81 lakh 55,705 is your remaining long-term capital gain. 81 lakh 55,705. So B is your correct answer. Here B is your correct answer. Now let me check. Okay. So in the MCQ number 1, yes, B is your correct answer. This question was not that easy. This question was not that easy because there were lots of confusion also in this question. I think, how many people did the right this question? First question, how many people answer were right? Just tell me. Is your answer were right? Done. Now question number 2. Pay attention. Mr. Ram is an Indian resident. Mr. Ram, Indian resident, purchased a residential house property in Gwalior in 1999 for 28.4 lakh. The fair market value and the stamp duty value of property is 33.5 lakh and 32.4 lakh. So guys, here stamp duty value is 32.4 lakh. So you will take the 32.4 lakh. You will take the 32.4 lakh instead of the FMV because FMV cannot be more than the SDV. So 32.4 lakh. On 5th Feb 2012, Mr. Ram enter into the agreement with Mr. Bhomkesh for the sale of such property for 74 lakh and received an advance of 3.9 lakh. However, that person did not pay the balance amount. Ram forfeited the advance. So this advance is forfeited before 1/4/2014. Answer is yes. It will be reduced from your cost of acquisition. What would be the index cost of acquisition of Mr. Ram if he sell the property today? So guys, can I say that here your cost of acquisition was 32,40,000 minus 3,90,000 was advance money forfeited. So your remaining amount is 32,40,000 minus 3,90,000. It comes to the 28,50,000 multiply by 348 divided by 100. So multiply by 3.48. It comes to the 99,18,000. 99,18,000. 99 lakh 18,000 is a right answer. 99 lakh 18,000. I think it is a right answer now. For second, it is a T. Now third question. Mr. X, age 61 years, earned the dividend income of the 12 lakh from ABC Limited 2324. Interest on loan taken for purpose of investment is 3 lakh. Income includable in income from other sources of Mr. X is, can I say that only 20% interest is allowed? So 12 lakh multiplied by 20% comes to the 2,40,000. So if you reduce 2,40,000, so here 9,60,000. 9,60,000 is correct answer. 9,60,000 is correct answer. Very simple question. Now question number 4. Mr. Vikas transfers 600 unlisted share of XYZ Private Limited to ABC Private Limited on 15 December 2023 at 3,50,000 when fair market value was 5,15,000. The index cost of acquisition of share of Mr. Vikas was 4,25,000. Determine the income chargeable to tax in hands of Vikas and ABC Private Limited in respect of the above transaction. So guys, here Vikas is transferring the share of the private limited company to the another company at 350, but market value is 515. So guys, here in hands of the Vikas, can I say that there is a section 50 CA? And 50 CA applicable. 50 CA says that in case of unlisted share, like we took the example of the Baiju, I sold my share to the Baiju or Unacademy of BB Private Limited and fair market value was higher, and I sold at some lower consideration and received the amount in the cash. So fair market value is full value of consideration due to section 50 CA. So here my full value of consideration is fair market value, that is 5,15,000, and my index cost of acquisition was 4,25,000. So guys, here 5,15,000 minus 5,15,000 minus 5,15,000 minus 4,25,000. So remaining is 90,000. This 90,000 is my long-term capital gain. It is taxable as a long-term capital gain in hands of Vikas. Now in hands of that company, can I say that that company purchased the share at 350? That company purchased the share at 350, and guys, FMV of that share is a 5,15,000. So difference of this 5,15,000 minus 3,50,000, so it comes to the 1,65,000. So 1,65,000 difference is more than 50,000. Answer is yes. So it is taxable under income from other sources. This 1,65,000 is taxable under income from other sources. So 90,000 is treated as a long-term capital gain and 1,65,000 taxable under income from other sources. So I think for the question number 4, answer C is a correct answer. So question number 4, answer C is a correct answer. After that, question number 5. Mr. Vikas received a gold ring worth rupees 60,000 on the occasion of his daughter wedding from his best friend Vishnu. So here Vikas is receiving the gold ring, but marriage is of daughter. Now, Mr. Vishnu's daughter also gifted a gold chain to Kavya, daughter of Mr. Vikas. Here Vikas received the gold ring of 60,000 on the occasion of daughter's wedding from his best friend Vishnu. Vishnu also gifted a gold chain to Kavya, daughter of Vikas. So like daughter of Vikas is going to get married. So here worth rupees 80,000 on that occasion. Would such gift be taxable in hands of Vikas and Kavya? So guys, Vikas received on the occasion of daughter's wedding, then it is taxable in hands of Vikas because FMV is more than 50,000, fully taxable. But daughter received on the occasion of marriage is not taxable. So here guys, in hands of Kavya it is not taxable, but in hands of Vikas it is taxable. So I think C is the right answer. Value of gold ring is taxable in hands of the Vikas, but value of gold chain is not taxable in hands of the Kavya. Now after that, question number 6. Question number 6 is a Akshay Biyani celebrating 26th birthday. 26th birthday he is celebrating. 26th birthday he is celebrating on 15th May 2023. Arrange a grand party at Radisson Blue Hotel. On this occasion, he invited his friend, his blood relative and distant relative to attend the party. The ceremony was very grand and the feast was also very spectacular. All the arrangement and decoration were absolutely wonderful. At the end of the party, Mr. Akshay was awarded by the gift of following and flower bouquet as information is given. So he got the some gift as well as flower bouquet also. So guys, which gift is taxable, which is not taxable, try to understand. He received from the mother 22 carat gold chain, received from the mother, and mother purchased on the same day only for this value. So when he received from the mother, then it is not taxable because from relative he got. From father he received the 22 carat gold bracelet. This is also not taxable. Father purchased on the same day for this value. He received from the wife also 4 gold ring. He received 4 gold ring from the wife, 4 gold ring. She purchased this ring on the 15 May 2023 for 35,500 each. Fair market value, today fair market value was 37,429. It is also not taxable because mother is covered in the relative, so not taxable. Father is covered in the relative, not taxable. Wife covered in the relative, not taxable. He received from the sister also. Painting, and painting fair market value 45,000. That is also not taxable because sister is also covered in the relative. Now next part. From cousin brother, that is father brother son, he is not relative. 1 gold chain he received and he purchased it on the same day for 18,200. It is taxable, but we have to check that the value is more than 50,000 or not. Now closest cousin, that is mother sister son or daughter, I-20 car is received. I-20 car not taxable because it is not covered in the shared security, jewelry, drawing, painting, sculpture, archaeological collection, any other work of art, bullion, virtual digital asset, any movable property. It is not covered in those assets, so it is not taxable. He received the friends and other distant relative. He received the cash of 1,50,000. Obviously, it is taxable. This 1,51,000 is taxable. Now, what happened? Mr. Akshay desired to set up a new manufacturing unit with his friend in partnership on 1st 12/2023. For making investment in the firm, he sold the following jewelry, which he has received on his 26th birthday celebration as a gift. So mother's gifted that gold chain, he sold for this value. Father gifted gold bracelets. Cousin brother gifted gold chain, also sold. His wife gave him 1 lakh as a gift so that he could invest sufficient money in the unit. On 1st December 2023, he invested 6 lakh, including the amount received on the sale of above gift and amount received from his wife and his friend invested 4 lakh in the firm. Based on the fact of the above case scenario given above, choose the most appropriate answer to the following question. Now, first question is, what is the amount of short-term capital gain taxable in hands of Akshay for the previous year 23-24 when he sold this asset, like mother gifted gold chain, father gifted gold bracelet, and cousin brother gifted gold chain? He sold, then what is the capital gain? Guys, you know that when he received this gift from the mother, father, or that cousin brother, mother, father, or cousin brother, guys, can I say that in this case, nothing was taxable under IFOS? When nothing was taxable under IFOS, then what should be the cost of acquisition? Cost to previous owner. Can I say that cost to previous owner? Period of holding is also from the previous owner. Indexation is also from the previous owner. So guys, here previous owner cost was 37,822. That is mother cost was 37,822. So here previous owner cost is, here it is a minus 37,822. So difference is short-term capital gain. Father cost was 56,075. So 56,075. Earlier it was not taxable under IFOS. So cost to previous owner. Now cousin brother gifted gold chain. Guys, this cousin brother gifted gold chain also not taxable. Why not taxable? Because value is not more than 50,000. And here what should be cost? Cost to previous owner, that is 18,200. So just reduce here 18,200. So minus 18,200. So what is the exact amount of the capital gain? 37,822 minus 42,150. So here it is a 4,328. Second is 60,180 minus 56,075. It's 4,105. And third is 20,600 minus previous owner cost 2,400. So here it is a short-term capital gain 4,328 plus 4,105 plus 2,400. So it comes to 10,833. This first answer is a correct answer. This first answer A is a correct answer of the question. This question A is a correct answer. Now next part. What is the gift amount not considered in income under section 56(2)(10)? So which is not considered in income, means which is the exempt income, you can say that. So guys, can I say that just you have to calculate here from mother, he received this amount. So this is exempt, not included. So 37,822 not included. 37,000. This is also not included. 56,075 not included. This from wife also not included. Now 37,429 multiply by 4, because 4 fair market value is 37,429. So this value of gift he received on that day, that is also not included. So 37,429 multiply by 4. So just multiply by 4. 37,429 multiply by 4 gold ring. So that comes to, I think, 149,716. That is also not included. After that, from sister, 45,000. That is also not included. This 18,200 also not included. 18,200 also not included. As well as this 4,10,000 also not included. 4,10,000 also not included. And guys, this is included now. This is included. And cash gift from wife. From wife, he received cash gift of 1 lakh as a gift, so that he could invest in the sufficient money in the unit. So he received the 1 lakh from the wife. This is also not included because from relative. So here it is a 1 lakh. So guys, here total comes to 8,16,813. So this is the right answer, C. First A and C. So here it is a A and C. A and C is a right answer. After that, what is the gift amount taxable in hands of Akshay? Only that 1,51,000. 1,51,000 cash from the friends and other relative. That 1,51,000 is taxable. So here guys, 1,51,000 is only taxable. So here 1,51,000 is only taxable. That is the point number A. Point number A. Done. After that, there is a question number 7. Question number 7 was also an antique question. It was very good question. Now guys, ABC Limited has 2 units, Unit A and Unit B, both of which commence the operation on 1/4/2015. So from 1/4/2015, there are Unit A and Unit B. Now it sold Unit B in the slum sale on the 1st July 2023 for 1.45 crore. So Unit B got sold for 1.45 crore. Unit B is engaged in the specified business of the operating warehousing facility for the storage of sugar and has claimed the deduction under section 35 AD in earlier previous year in respect of the entire cost of the building purchase. Means for the building purchase on this building, they already claimed the deduction under section 35 AD. That is Unit B. Now on 1st July 2023, following particular relating to Unit B are as given below. They have given the land revalued figure. This is the revalued figure. Stamp duty value is given. For the building, this is the book value. This is the stamp duty value. Debtors also, unsecured loan also, current liability also, and revaluation reserve also given towards the land. They are asking what is the amount of capital gain on sale of Unit B. So guys, always remember, first we have to take the full value of consideration here. All people try to understand how to calculate the full value of consideration. So guys, for full value of consideration, we will calculate that FMV1 and FMV2. We will calculate later, okay? Minus your cost of acquisition. You know that in slum sale, your cost of acquisition is always net worth. Now in the net worth, first take the asset minus liability. Asset minus liability. And asset, depreciable asset, take as WDV. Other asset, take at book value. Liabilities take at book value, and WDV as per the income tax law. But you know that we have discussed the 2 point while net worth calculation. If any asset that is the self-generated asset, you have to take the value as a nil. And if there is any asset on which 35 AD deduction already claimed, that also you have to take as nil while calculating net worth. While calculating net worth for any asset, when asset self-generated, just take the nil as a value, and on any asset if you claim the 35 AD deduction, then also take the nil as a value. So here guys, in asset there is a land, but land also 80 lakh, but we will ignore the revaluation effect. Revaluation is a 6 lakh. So can I say that land I will take at only 74 lakh? Here land I will take at 74 lakh for the calculation of the net worth 74 lakh. Now building I will not consider because on building you already claimed the 35 AD deduction. I will claim the debtors. I will consider the debtors of the 12 lakh. 12 lakh rupees is a debtor. Debtor is 12 lakh. Now liability is a 15 lakh and 5 lakh. So total 20 lakh is your liability. Total 20 lakh is your liability. So can I say that here your net worth comes to 74 lakh is your asset plus 12 lakh debtors minus 20 lakh So it comes to the 66 lakh. So 66 lakh is your net worth. Now question is that what should be the full value of consideration? So for full value of consideration, we have to calculate FMV1 and FMV2. And if you remember FMV1, you know that we have to take the A plus B plus C plus D minus L. And for the FMV2, that is the E plus F plus G plus H, means whatever you received. So what you received? So FMV2 is very simple. You received the 1.45 crore, I think. So 1.45 crore only monetary consideration you received. So just take the 1.45 crore. Now FMV1 is a net worth. That is FMV of this unit. Now if you remember, then we have discussed that whatever unit you transfer for the A, like first ignore the 10 asset. Which 10 asset? Share, security, jewelry, drawing, painting, sculpture, archaeological collection, any other work of art, and bullion, and immovable property. For this asset you have to take the FMV and SDV, and all other asset you have to take at book value. All other asset you have to take at book value. So guys, can I say that for the here there are immovable property, this two are immovable property, we will take the SDV. So here in the point number D for SDV, and here we will consider the building. Here we'll consider the building. For net worth calculation, if any asset is on which you claim the deduction under section 35AD, that is not considered, but here we will consider that. So 95 and 60. 95 plus 60, that is the D, that immovable property you transfer, we will take the SDV of the both the asset, SDV 95 and 60. So here D is 95 plus 60. Now all other asset we have to take at book value. So other asset is a 12 lakh only. So 12 lakh, here 12 lakh, and liability you will reduce at book value. So liability is a here 2 liability, that is the 20 lakh. So 20 lakh. Now you calculate FMV1, 12 lakh plus 95 lakh plus 60 lakh and minus 20 lakh. So it comes to the 147. 1 crore 47 lakh is your FMV1, and FMV2, whichever is higher, is FMV1. So here guys, 1 crore and 47 lakh is your FMV1 minus 66 lakh. So it comes to the 81 lakh is your long-term capital gain. So here long-term capital gain is 81. 81 is your long-term capital gain. D is the right answer. Last question. Mr. J acquired market linked debenture of 20 lakh. 20 lakh market linked debenture MLD he acquired in 2019, and now he transfer such debenture for 28 lakh. What is the amount of capital gain on sale of the MLD? So in case of the market linked debenture, there is always short-term capital gain. Always there is a short-term capital gain. So B is the right answer. Short-term capital gain 8 lakh. Section 50AA we have discussed. So section 50AA we have discussed. So here short-term capital gain is of the 8 lakh in case of the market linked debenture. Now for the descriptive question, guys, this first question was very easy. First question was very easy. That was related to the section, I think 112A and all. This first question was very easy. Solution is also given here. Just you will check the solution, you will able to understand. No worry at all. Now we are going to discuss the solution of the question number 2, because question number 2 was related to the 9B and 45.4. 9B and 45.4. 9B and 45.4, and this question was from the May 2023 exam. This question was from the May 2023 exam. Now what happened in this particular question? Try to understand. LMN are three partner of the L&G Associates. So they are three partner, a partnership firm established in the 1995. L retired from the firm on the July 27, 2023 in the current year. After his retirement, business of the firm will be operated by the M and N. Capital account balance of the L on the July 27, 2022 was 20 lakh. 20 lakh was the capital balance. There is no revaluation of asset in the books of the firm at any time after 3-4 when L joined the firm as a partner. Now firm gives the L the following asset to settle his account. He received the cash of 1 lakh. He also received the stock in trade. Fair market value is 2 lakh and the stock was purchased on the 15th April 2023 for 1,20,000. Plot of land at Kota received fair market value of plot on this date is 17 lakh. Book value of plot is 17 lakh. It was acquired in the 98-99 for 60,000 and fair market value of the plot on 1/4/2001 was 1,10,000. You are required to calculate the taxable income as per the provision of Income Tax Act 1961 for L&G Associates for the assessment year 24-25. So we are going to check the in hands of the L&G Associates. So guys, try to understand. Always first check the 9B. Always first check the 9B. So here guys, in hands of the partnership firm, that is L&G Associates, previous year 23-24, assessment year 24-25. Now guys, 9B, as per section 9B, what section 9B says that as per section 9B, 9B says that on the either on the dissolution or on the reconstitution of partnership firm, if any stock in trade is transferred or any capital asset is transferred, then in hands of the partnership firm there is a PGBP income or capital gain or both. There is a PGBP income or capital gain or both. So both apply in hands of the partnership firm, either capital gain or PGBP or both, whenever on reconstitution if any capital asset or stock in trade is transferred. So guys, in this particular case, is capital asset or stock in trade is transfer? Answer is yes. Here stock is transfer, here capital asset is transfer. So guys, here capital gain is also applicable and PGBP income is also there. So here in case of in hands of this partnership firm, first is capital gain and second is PGBP income. So one here, first is your plot at Kota. So this is plot at Kota. And here stock in trade. So full value of consideration, you will take the FMV as on transfer. FMV as on date of transfer. So here FMV as on date of transfer for plot, FMV is given as 17 lakh rupees. 17 lakh rupees FMV is given. And for stock in trade, that FMV is, stock in trade FMV is 2 lakh rupees. Now guys, for plot of land, there is a capital asset, index benefit is available. Answer is yes. So minus index cost of acquisition. Your cost was 1,10,000. Your cost was 1,10,000. Multiply by, cost was 1,10,000 and multiply by 348, that is index of current year 23-24, divide by 100, that is a 1 2. Your cost was 60,000. FMV higher, so we will take the FMV. So here 1,10,000 multiplied by 3.48, it comes to the 3,82,800. 3,82,800. And for stock in trade, directly we take the cost of the stock. So here cost of stock was 1,20,000. So here guys, 1,20,000. So can I say that here your income comes to the, here your income comes to 17 lakh minus 382,800. So it's 13 lakh 17,200 is long-term capital gain. And guys, this 80,000 is your PGBP income. This is as per section 9B. This is as per section 9B. Now guys, in this particular case, if you remember our class discussion, then in class discussion what we did, on this capital gain we calculated the tax amount also, and we checked that what will be the accounting treatment and all, and whatever profit we distributed to the partner and we increase the partner capital. But in this question PSR is not given. In this particular question, Meghna, PSR is not given, because if you read the question, they have not given the PSR. So if we calculate the accounting profit also, then we don't know aware about the PSR. What is the PSR? So PSR is not given, so we will not give the impact on the capital. What will be impact on the capital? Because his capital balance was 20 lakh. His capital balance was 20 lakh. But guys, like this profit, what will be the accounting treatment? That is not given. Why we are not calculating? Because here PSR is not given. If you read the question, they have not given the PSR. What is the PSR? So there may be one assumption. Can you assume that PSR is a equal PSR? Equal PSR of all three. Then what you will do? On LTCG, you will calculate the tax at the rate 20%. After that, for the PGBP income, you will calculate tax as per 30%. After that, add the health and education cess, that will be a net tax. After that, you will check the accounting profit. How you will check the accounting profit? That is, stock is transferred at 2 lakh and 1,20,000. Difference comes to the 2 lakh and 1,20,000. That difference comes to the 80,000. 80,000 is accounting profit of stock. And here also accounting profit on the plot. Your accounting profit on the plot will be your book value at 17 lakh. And suppose that plot plot of land you sold at 17 lakh only. So here guys, there is no accounting profit here. Only 80,000 is accounting profit. And after that, but I think ICI will not do that. ICI suggested answer is not released till now. ICI is not going to do that because PSR is not available. As well as one point, 45(4) is applicable or not? Logically it is applicable, but under 45(4) there will not be any capital gain. Why? Because if you remember the 45(4) na, if you remember the 45(4), what we have discussed in 45(4), 45(4) says that if there is a dissolution of partnership firm, 45(4) is applicable only in case of the dissolution. In case of the dissolution of partnership firm, if any capital asset or money is distributed to partner, then there is a capital gain. And when there is a capital gain, if money or asset is given and that is more than the capital balance. Here guys, when you calculate the capital gain in 45(4), then can I say that here money is received by that person, that money amount is 1 lakh? That money amount is 1 lakh, and second is a fair market value of capital asset. Fair market value of capital asset, and fair market value of capital asset is a 17 lakh. And for 45(4), we never consider the stock in trade. So here its total comes to the 18 lakh. But guys, his capital balance itself is 20 lakh. His capital balance itself is 20 lakh. So this amount is treated as a nil. Because in 45(4) we have discussed that if this amount comes the negative na, then it is treated as nil. So in simple word, under section 45(4), nothing is taxable. Under section 45(4), nothing is taxable. So this is the question number 2. This question is of 5 marks. Suppose if you have completed this much only, if you completed the 9B and just you have written one note for the 45(4), since in this particular question money and FMV of asset, capital asset received by that partner, that is not more than his capital balance. So 45(4), there is no taxability under section 45(4). If you have written this much also, you are going to get the 5 marks in your examination. Okay, so done people. This is all about the test paper number 2. This PDF file I am going to upload on your drive also, so you can check whenever. If you want to check any noting, then you can check it. Okay, so thanks a lot people. That's enough for today from my side. Tomorrow we will start with the new topic, that is the PGBP. Everything we have completed till now we are going to start with the PGBP, and that topic is going to cover approx 10 marks in your approx 20 marks in your examination. There will be a 14-mark question, that total income question, and in total income question 70-80% adjustment will be from the PGBP only, remaining adjustment from capital gain or house property or other sources and all. Okay, so thanks a lot people. That's enough for today from my side. See you tomorrow. Bye, take care.